What is a negotiable bill of lading versus non-negotiable? Imagine you're sending a valuable shipment across the world. You want to make sure the right person gets it and that the process is smooth. That's where the bill of lading comes in. It's a key document in logistics and transportation, especially in freight and shipping. It acts as a contract between the shipper and the carrier, a receipt for the goods, and sometimes proof of ownership. Now, the big question is, what's the difference between a negotiable and a non-negotiable bill of lading? Let's break it down. A negotiable bill of lading is a document that can be transferred from one person to another. Think of it like a check that you can endorse and pass along. If you hold the original, properly signed negotiable bill of lading, you can claim the goods from the carrier. This type is often called an order bill of lading because it's made out to order of a specific person or company. This means ownership of the goods can change hands while the shipment is still on the move. It's especially useful in international trade where goods might be sold multiple times before reaching the final buyer. It also plays a big role in trade finance, as it can be used as collateral for loans or to secure payments under letters of credit. For example, a seller might only give the endorsed bill of lading to the buyer after receiving payment, adding security to the transaction. On the other hand, a non-negotiable bill of lading, sometimes called a straight bill of lading, is issued directly to a specific person or company named as the recipient. Only that person or company can take delivery of the goods from the carrier. This document cannot be transferred to someone else by endorsement. It does not act as a document of title, which means it doesn't prove ownership of the goods. Instead, it simply confirms that the carrier has received the goods and will deliver them to the named recipient. Non-negotiable bills are used when the ownership of goods is not expected to change during transit. They are easier to manage because there's less risk of the document being transferred to an unauthorized person. In logistics and supply chains, choosing between these two types of bills impacts how goods are bought, sold, and financed. Negotiable bills allow ownership to change hands during transit, which is helpful for international trade and financing. They are often required for transactions involving letters of credit because they serve as proof of ownership. Non-negotiable bills are simpler and safer when the ownership is fixed from the start, making them ideal for straightforward shipments where the buyer is known and payment is secure. Understanding these differences helps companies decide which bill of lading to use. If a shipment needs to be sold or used as collateral while still moving, a negotiable bill is the way to go. But if the goal is a simple delivery to a known recipient, a non-negotiable bill keeps things straightforward. Remember, the key is that a negotiable bill can be transferred to others, allowing ownership to change during transit. A non-negotiable bill only allows the named recipient to claim the goods, making it more secure but less flexible. This choice influences how goods are traded, financed, and protected in global supply chains.